There's a Medicare penalty hiding in plain sight that catches thousands of retirees off guard every year. It can cost a married couple over $10,000 in extra premiums in a single year, and most people don't even know it exists until they get a letter in the mail saying their premiums just went up. It's called IRMAA or IRMAA, and once you understand how it works, you can avoid it. Here's what you need to know. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on Medicare premiums for higher-income retirees. The idea is that wealthier seniors pay more for their Medicare coverage than lower-income seniors. That sounds fair enough on paper. The problem is that IRMAA hits a lot of people who don't think of themselves as wealthy at all, and it can be triggered by financial moves that seem completely normal. Medicare Part B covers doctor visits and outpatient services. Medicare Part D covers prescription drugs. Most Medicare beneficiaries pay a standard monthly premium for both. But if your income is above certain thresholds, Medicare adds a surcharge, IRMAA, to both your Part B and Part D premiums. The higher your income, the bigger the surcharge. For 2026, the standard Medicare Part B premium is around $185 a month. If you trigger the first IRMAA tier as a married couple filing jointly, that premium jumps by roughly $75 per month per spouse. Hit the highest tier, and you can be paying over $600 per month per spouse just for Part B. Now add Part D surcharges on top of that, then multiply by 2 spouses, then multiply by 12 months. You're looking at thousands of extra dollars a year in Medicare costs. IRMAA is tiered. For married couples filing jointly in 2026, here are the rough income thresholds. The first tier kicks in at about $212,000 of modified adjusted gross income. The next tier hits around $266,000. It keeps climbing from there, with the highest tier hitting at incomes above $750,000. For single filers, the thresholds are roughly half of those numbers. Here's the thing that catches people. These thresholds sound high, but they're based on something called modified adjusted gross income, which can include income sources you might not expect. Modified adjusted gross income for IRMAA purposes includes basically all your taxable income, wages and self-employment income, retirement account withdrawals, including traditional 401k distributions and traditional IRA distributions, the taxable portion of Social Security, capital gains from selling investments, dividends and interest, pension payments, rental income, and it adds back any tax-exempt interest you earned. So if you sell a big asset, like a vacation home or a chunk of appreciated stock, that income counts. If you do a large Roth conversion, that counts. If you take a big distribution from a retirement account, that counts. A retiree pulling $50,000 a year in retirement income normally would never trigger IRMAA. But if that retiree sells a rental property and takes a $200,000 capital gain in the same year, suddenly they're well above the first IRMAA threshold. Here's the part that really trips people up. IRMAA is based on your income from 2 years ago. So, your 2026 Medicare premiums are based on your 2024 tax return. Your 2027 premiums are based on your 2025 tax return. This matters for 2 reasons. First, IRMAA can hit you years after the financial move that triggered it. Someone who did a big Roth conversion in 2024 to take advantage of a low tax year might be shocked when their Medicare premiums spike in 2026. Second, IRMAA assumes your situation hasn't changed. If you had a high-income year in 2024 because you sold a business or had a one-time event, but you're now retired with much lower income, you might still face the IRMAA surcharge in 2026. There are appeal processes for life-changing events, but they require paperwork. IRMAA has what's called a cliff effect. Cross a threshold by $1, and your premiums jump significantly. There's no gradual increase. Let me give you an example. A couple with modified adjusted gross income of $211,999 pays the standard Medicare premium. A couple with modified adjusted gross income of $212,001 pays the first-tier IRMAA surcharge, adding hundreds of dollars per month to their combined Medicare premiums. That $2 difference in income could cost them thousands of dollars over the year. That's the cliff. This cliff effect means that careful tax planning around IRMAA thresholds can be enormously valuable. Here are the strategies retirees use to manage IRMAA exposure. Strategy 1. Spread out income over multiple years. If you need to do a Roth conversion, spread it over 5 years instead of doing it all in 1 year. If you need to sell appreciated investments, spread the gains over time. The goal is to stay just under IRMAA thresholds rather than spiking into them. Strategy 2. Time big income events carefully. If you're considering a big financial move, look at your modified adjusted gross income forecast. Sometimes pushing a transaction into next year or pulling it forward into this year makes a difference. Strategy 3. Use tax-free income sources, Roth withdrawals, qualified health savings account distributions, and other tax-free income don't count toward IRMAA. If you have these buckets, use them strategically in years when you're close to a threshold. Strategy 4. Consider qualified charitable distributions. If you're over 70 and a half, you can give up to $100,000 directly from your IRA to charity each year. This counts toward your required minimum distribution, but doesn't show up in your taxable income, which means it doesn't count toward IRMAA. Strategy 5. Appeal life-changing events. If your income dropped significantly due to retirement, divorce, death of a spouse, or other major life events, you can appeal IRMAA. The form is called Social Security Form 5634. It's worth doing if it applies to you. This is important enough to call out specifically. Many retirees do Roth conversions in their late 60s to take advantage of low-income years. Those conversions are often the right move from a long-term tax perspective, but they can trigger IRMAA 2 years later if you're not careful. The fix isn't to avoid Roth conversions. The fix is to plan them with IRMAA in mind, stay under the threshold, spread conversions over multiple years, run the numbers before you convert. Let me give you a concrete case. A married couple, both age 67, both on Medicare. Their normal retirement income is about $90,000 a year, well below any IRMAA threshold. In 2024, they decided to convert $140,000 from a traditional IRA to a Roth IRA. They knew this would increase their tax bill that year, and they accepted that cost. What they didn't think about was IRMAA. The Roth conversion pushed their 2024 modified adjusted gross income to $230,000 over the first IRMAA threshold. In 2026, their Medicare Part B premiums increased by about $170 per month per spouse, plus Part D surcharges. Their total extra Medicare cost for the year was around $4,500. That's on top of the tax they'd already paid on the conversion. Was the conversion still worth it? Maybe. But they could have done the same conversion over 2 years instead of 1, kept both years under the IRMAA threshold, and saved that $4,500 entirely. Here's what I wish more retirees understood about IRMAA. It's not just a Medicare issue, it's a financial planning issue. Every major income decision in retirement, Roth conversions, big asset sales, large withdrawals, should be evaluated against IRMAA thresholds. A few $100s of unnecessary income can cost you thousands in Medicare premiums. Plan ahead, watch the thresholds, and don't let the IRS sneak this one past you. If you'd never heard of IRMAA before today, hit that like button and let me know in the comments. Were you aware Medicare premiums could increase like this? I'd love to hear how you're planning around it. And if you want more content that helps you keep more of your retirement money, Subscribe. I share exactly what I wish I knew so you can make smarter money moves.